Stop looking at New York. If you want to understand the origins of the money in your pocket, the stock market on your phone, and the banking system that rules your life, you are looking at the wrong century, and you are definitely looking at the wrong city. We are conditioned to believe that modern capitalism was forged in the steel and glass canyons of Wall Street or the imperial halls of Victorian London. This is a lie. The financial architecture of the modern world wasn't built by Americans or the British. It was engineered nearly 400 years ago in a swampy, flat, resource-poor river delta by a group of merchants who cared more about profit than they did about kings or popes. Before the dollar, before the pound sterling, and long before the Dow Jones, there was a financial superpower so dominant that it invented the very concept of the publicly traded company. Today, we are going to uncover the forgotten empire that turned debt into wealth and speculation into a science. Welcome to the true birthplace of finance. To understand this financial superpower, we must first analyze the sheer geographic and political anomaly of its existence. The Dutch Republic of the late 16th and early 17th centuries had absolutely no business being a global empire. By every conventional metric of the time, it should have been a vassal state. It possessed almost no natural resources, no gold mines, no vast timber forests, and barely enough arable land to feed its own population. It was a collection of 7 bickering provinces constantly threatened by the ocean, requiring massive, expensive dikes just to keep the land dry. Furthermore, it was surrounded by hostile, centralized monarchies, Spain, France, and England, that commanded vastly larger armies and had exponentially larger populations. Yet, by the mid-1600s, this tiny republic controlled nearly half of Europe's shipping trade. How did they achieve this impossible leverage? They didn't win by land. They won by radical efficiency and a complete reimagining of what value meant. While their neighbors were obsessed with religious wars, feudal honor, and the accumulation of static land, the Dutch were obsessed with data, logistics, and capital accumulation. They realized early on that economic liquidity was a weapon far more potent than gunpowder. The Dutch turned their primary liability, the lack of land, into their greatest asset. Because they could not expand inward, they were forced to look outward to the sea. This created a unique culture where commerce was not just a job, but the highest civic virtue. Unlike in France or Spain, where the aristocracy looked down upon merchants as second-class citizens, in the Dutch Republic, the merchants were the aristocracy. This social structure meant that the government's policies were designed exclusively to facilitate trade. They pioneered the concept of bulk-carrying trade. While other nations built ships to carry expensive luxury goods for the king, the Dutch built ships to carry grain, timber, and salt for the masses. They operated on razor-thin margins, prioritizing volume over high markups per unit. They became the wagoners of the sea, moving goods between other nations better and cheaper than those nations could do themselves. If a French merchant wanted to sell wine to Russia, they likely hired a Dutch ship to move it. This control over logistics gave them a stranglehold on the European economy long before they fired a shot in anger. They understood that if you control the flow of goods, you control the price of goods. This mindset laid the fertile, muddy groundwork for the financial revolution that was about to explode in Amsterdam. In 1602, an event occurred in Amsterdam that changed the trajectory of human history more than the French Revolution or the invention of the steam engine. The Dutch government, under the guidance of the shrewd statesman Johan van Oldenbarnevelt, forcibly amalgamated several competing pre-companies, known as Voorkompagnien, into a single, unified entity, the Verenigd Oost-Indisch Company, VOC, or the Dutch East India Company. Before this moment, trade expeditions were temporary ventures. Merchants would pool their money for a single voyage to the East Indies to buy spices. If the ship returned, the profits were divided, the assets liquidated, and the partnership dissolved. It was a high-risk, short-term model. The VOC changed everything. It was designed as a permanent legal entity, independent of its investors, and designed to exist in perpetuity. This was the birth of the modern corporation. But the VOC was not merely a trading guild. It was a sovereign power disguised as a business. The Dutch government granted the VOC a charter that gave it powers usually reserved for nations. It could wage war, build fortresses, sign treaties with foreign potentates, mint its own coins, and imprison convicts. It was a state within a state. From a financial history perspective, The VOC represents the pivotal moment where the corporation surpassed the kingdom as the primary driver of global economic expansion. The scale of the VOC was staggering. It wasn't just about trading pepper and nutmeg. It was about establishing a monopoly through force and finance. The company had the authority to attack Spanish and Portuguese shipping, effectively privatizing the war against Spain. This allowed the Dutch Republic to damage their enemies without spending public tax dollars. The company paid for the war out of its profits. This structure solved the agency problem that plagued earlier trade. By creating a permanent board of directors, the Heeren 17, the Lords 17, the company could plan for decades rather than months. They could build shipyards, establish permanent outposts in Jakarta, then Batavia, and create long-term supply chains. This permanence allowed them to dominate the spice trade, driving competitors out of the market and setting prices across Europe. The VOC was the first institution to prove that a corporate entity could be more powerful, more efficient, and more durable than a government. It was the prototype for every multinational giant that exists today, from Amazon to Apple. With the structure of the VOC established, the directors faced a critical problem: capitalization. Building a fleet capable of sailing to the Spice Islands, modern-day Indonesia, fighting off Portuguese warships, and maintaining a supply chain for 2 years required immense amounts of money, far more than any small group of merchants could provide out of their own pockets. The traditional model of financing, where a few wealthy patrons funded a voyage, was insufficient for the scale of the VOC's ambition. To solve this, the Dutch innovated a financial mechanism that is now the bedrock of global capitalism. They decided to open the company's capital to the general public. In 1602, the VOC opened a subscription register in Amsterdam. Any resident of the Dutch Republic, regardless of social class, could invest money in the company in exchange for a share of the future profits. This was the first initial public offering, IPO, in history. The result was a social and financial revolution. The subscription book records show that investors included not just wealthy merchants and bankers, but also cheesemongers, maids, artisans, and widows. The democratization of investment meant that for the first time, the general population could own a fraction of the means of production of a global empire. This influx of capital gave the VOC a liquidity advantage that no rival monarchy could match. While the King of Spain had to beg bankers for loans at high interest rates to fund his fleets, the VOC had a massive pool of debt-free equity capital provided by its own citizens. Crucially, the VOC charter introduced the concept of limited liability in practice, if not yet fully in law. Investors were liable only for the amount they invested. They could not lose their personal homes or other assets if the company went bankrupt. Though this legal concept would take time to fully mature, the functional separation of personal and corporate assets began here. This IPO detached capital ownership from management. The cheesemonger who bought 100 guilders of stock had no say in how the ships were sailed or which treaties were signed. He only had a claim on the dividends. This separation created the modern shareholder model we use today. It turned capital into an abstract, impersonal force. Money was no longer tied to the person who owned it. It was tied to the share. This allowed the VOC to raise 6.4 million guilders, a colossal sum at the time, giving them the financial war chest needed to crush their European rivals and enslave the spice markets of the East. With the shares of the VOC in existence, the directors and investors immediately ran into a secondary, unforeseen problem: liquidity. The VOC charter had a specific clause that made the capital permanent. Unlike previous trade missions where the money was returned to investors after the ships came back, the VOC money was locked in. You could not go to the company headquarters and ask for your 100 guilders back. This permanence was great for the company. It meant they could build forts and fleets without worrying about cash flow, but it was terrible for an investor who needed cash for an emergency. This constraint forced the creation of a solution that defines the modern world: the secondary market. If you couldn't get your money back from the company, you had to find someone else to buy your claim to the profits. Investors began to meet informally to trade these papers. Initially, they met on the New Bridge or in the open air near the harbor. But as the volume of trade grew, the city recognized the need for a dedicated space. In 1611, the Amsterdam Stock Exchange, the Beurs, was opened. This was the first time in human history that ownership became a liquid asset, tradable on a momentary basis. The Bourse was a frantic, noisy, open-air courtyard where hundreds of merchants gathered daily. It was here that the psychology of the market was born. The price of VOC stock was no longer just about the book value of the ships and spices. It was about sentiment. It fluctuated based on news, rumors of shipwrecks, harvest reports from the East, and political gossip. For the first time, wealth was divorced from tangible reality. In the feudal age, wealth was land, cattle, or gold, things you could touch. In the Amsterdam Bourse, wealth became a number on a ledger that moved up and down based on collective belief. The concept of market value as distinct from intrinsic value emerged here. Traders developed the first jargon of the market. They identified bulls, trading for the rise, and bears, trading for the fall, though the Dutch terms were different, liefhebbers and controminus. This secondary market was critical because it lowered the risk for investors. Knowing that you could sell your stock at the Bourse if you needed to made people more willing to invest in the first place. It created a cycle of liquidity that fueled the Dutch economy. The exchange became the nerve center of the Republic. It was said that you could gauge the health of the nation not by looking at the king's treasury, but by standing in the courtyard of the Bourse and listening to the roar of the crowd. If the noise was frantic and panicked, the Republic was in trouble. If it was steady and boisterous, business was good. The stock market had become the heartbeat of the state. Where there is a market, there is manipulation. It did not take long for sophisticated traders to realize that they could profit from the company's failure just as easily as they could profit from its success. The financial ecosystem of Amsterdam was evolving rapidly, and with it came the darker arts of trading. The central figure in this evolution was Isaac Le Maire, a man who can arguably be called the father of modern financial warfare. Le Maire was a wealthy merchant and one of the original major investors in the VOC. However, after a bitter dispute with the company directors over accounting irregularities and his own embezzlement accusations, he was ousted. Burning with a desire for revenge, Le Maire didn't just want to leave the company. He wanted to destroy it. He realized that the share price of the VOC was vulnerable to sentiment. If he could drive the price down, he could hurt the directors and make a fortune in the process. Le Maire engaged in the first recorded instance of short selling on a massive scale. The mechanism was ingenious and dangerous. He sold shares he did not actually own to other buyers, promising to deliver them at a future date for a set price. His gamble was simple. He believed the price of the stock would crash before the delivery date. If he promised to sell a share for 100 guilders and the market price dropped to 80 guilders by the time he had to deliver, he could buy the share at 80, hand it over to the buyer, and pocket the 20 guilder difference. To ensure the price dropped, Le Maire organized what we would today call a bear raid. He formed a secret syndicate of traders to coordinate their selling. Simultaneously, he launched a disinformation campaign. He spread rumors that VOC ships had sunk in storms, that the King of France was about to seize Dutch assets, and that the spice trade was collapsing. He weaponized fear. This activity was so disruptive that it caused the first stock market crash in history. The Dutch government, alarmed by the plummeting value of their national champion, intervened. They passed laws in 1610 banning naked short selling, selling shares you don't own, calling it wind handle, trading in the wind. But the damage was done, and the precedent was set. Le Maire had proven that financial markets could be decoupled from reality and used as a battlefield. He demonstrated that in a liquid market, pessimism is a tradable commodity. While Le Maire eventually lost much of his fortune in continuous litigation, he left behind the blueprint for every hedge fund and short seller that operates on Wall Street today. The derivatives market, the ability to trade on the direction of value rather than the asset itself, had arrived in the mud of Amsterdam. While the stock market generated wealth and speculation, the practical day-to-day trade of the Dutch Republic faced a massive logistical hurdle: the currency itself. Europe in the early 1600s was a monetary nightmare. There was no single euro or dollar. Instead, there were hundreds of different coins circulating from various duchies, kingdoms, and city-states. Merchants in Amsterdam had to deal with Spanish reals, French pistoles, English crowns, and dozens of German thalers. To make matters worse, many of these coins were clipped or sweated, meaning unscrupulous people had shaved off bits of gold or silver, reducing their value. A merchant selling timber never knew if the coins he was receiving were actually worth their face value. This friction slowed down trade, caused endless disputes, and made sophisticated accounting nearly impossible. The Dutch realized that to become the center of global trade, they needed a standardized, reliable medium of exchange. In 1609, the city government founded the Amsterdamse Wisselbank, Bank of Amsterdam. This institution was the precursor to the modern central bank, but it operated differently than banks do today. It was not a lending bank, it was a deposit and exchange bank. Merchants could bring their chaotic mix of foreign, clipped, and worn coins to the bank. The bank would weigh and assay the metal content of these coins and then credit the merchant's account with a standardized value expressed in bank guilders, or bank money. This bank money was revolutionary. It was purely a ledger entry, a digital currency before computers. Because the Bank of Amsterdam had a reputation for absolute integrity and held 100% reserves of precious metal to back the deposits, bank money was considered better than cash. In fact, it often traded at an agio, a premium, over physical coins. Merchants preferred to be paid in bank transfers rather than heavy bags of questionable metal. The Wisselbank stabilized the Dutch economy and made Amsterdam the clearinghouse for global trade. If a merchant in London wanted to pay a merchant in Russia for furs, they wouldn't ship gold across the sea. They would simply transfer funds between their accounts at the Bank of Amsterdam. The bank became the ledger of Europe. This efficiency reduced the transaction costs of trade significantly. While other nations struggled with debased currency and inflation, the Dutch had a stable, fiat-like currency that was trusted universally. This financial stability allowed for lower interest rates across the entire economy. Because the currency was stable and the legal system enforced contracts, lenders were willing to lend money at 3% or 4% interest, whereas in England or France, interest rates were often double or triple that. This cost of capital advantage meant that a Dutch merchant could borrow money to fund a voyage and still make a profit at a lower margin than his English competitor. The Bank of Amsterdam was the invisible engine that allowed the tiny republic to punch vastly above its weight, proving that trust and accounting were just as important to empire building as ships and cannons. While the Bank of Amsterdam provided the financial software, the Dutch Republic needed superior hardware to dominate global trade. In the 17th century, that hardware was the ship. However, most European nations were building ships that were jacks of all trades. An English or Spanish galleon was designed to carry cargo, but also to carry heavy cannons and a large contingent of soldiers to defend against pirates and rivals. This made these ships heavy, expensive to build, and incredibly costly to operate. The Dutch took a different, purely analytical approach to maritime engineering by inventing the flight. The flight was the first ship designed strictly for economic efficiency rather than naval glory. It was a dedicated cargo vessel. It had a pear-shaped hull that was wide at the bottom to maximize storage space and narrow at the deck. This narrow deck was a clever bit of financial engineering. At the time, many ports, including the crucial Sound, the strait between Denmark and Sweden, taxed ships based on the area of their main deck. By shrinking the deck and bulging the hull below the waterline, the Dutch significantly reduced their tax liabilities. This was tax avoidance built into the very architecture of their fleet. Furthermore, the flight was engineered to be operated by a skeleton crew. While an English merchant ship of comparable size might require 30 sailors, a Dutch flight could be managed by just 12 or 15. They achieved this through a revolutionary system of blocks and tackles that made handling the sails much easier. By minimizing the crew, they slashed their largest operating expense, OPEX wages and food. The ship was also built using standardized parts and wind-powered sawmills, which made the construction cost nearly 40% cheaper than their rivals. This technological superiority created a massive competitive advantage. Because their ships were cheaper to build, taxed less, and required fewer sailors, the Dutch could offer shipping rates that no one else could match. They became the logistical backbone of the world. They were not just trading their own goods, they were the delivery service for every other nation's goods. This efficiency turned the shipping industry itself into a high-yield financial instrument. The Dutch didn't just win because they were better sailors. They won because they had optimized the cost per ton of global transport. By the mid-1600s, the Dutch merchant fleet was larger than the fleets of England, France, Spain, Portugal, and Germany combined. This dominance in the physical world was the ultimate collateral that backed the abstract wealth growing in the Amsterdam stock market. Every financial superpower eventually faces the danger of its own liquidity. By the 1630s, the Dutch Republic was so flush with capital that investors began looking for higher yields outside of the established VOC shares and government bonds. This excess of money, combined with a sophisticated understanding of futures contracts, created the perfect conditions for the world's first recorded major asset bubble, Tulip Mania. Tulips were a status symbol, a rare and exotic flower imported from the Ottoman Empire. However, the market became truly irrational when broken bulbs, those infected with a virus that created beautiful, flame-like patterns on the petals, became the focus of intense speculation. As prices rose, people from all levels of society began to enter the market, not because they wanted the flowers, but because they believed they could sell the bulbs to a greater fool for a higher price next week. The financial sophistication of Amsterdam was weaponized during this period. Because tulips only bloom in the spring, and bulbs can only be moved in the summer, the market shifted to paper trading. Investors signed contracts before a notary to buy bulbs at the end of the season. These were essentially the first commodity futures. People were trading the promise of a tulip that hadn't even grown yet. By 1636, the prices became disconnected from any earthly reality. A single bulb of the Semper Augustus variety was reportedly valued at 5,000 guilders, roughly the cost of a luxury house in Amsterdam or 20 times the annual salary of a master carpenter. The crash was as swift as it was inevitable. In February 1637, at an auction in Haarlem, a buyer failed to show up. A sudden chill of doubt swept through the room. If no one was buying, the price was zero. Within days, the panic spread to Amsterdam. The market for paper contracts evaporated instantly. While modern historians debate how much the crash actually damaged the overall Dutch economy, many of the trades were never settled and stayed as bad debts between individuals. The psychological impact was profound. Tulip mania remains the ultimate case study in irrational exuberance. It proved that even the most sophisticated financial minds in the world were susceptible to the FOMO, fear of missing out, and herd mentality that define human psychology. It served as a warning that when money becomes too easy and speculation replaces value creation, a collapse is always on the horizon. For the Dutch, it was a momentary fever, but it revealed the inherent volatility of the very capitalist systems they had worked so hard to invent. By the mid-17th century, the financial machine in Amsterdam was no longer just a European phenomenon. It had become the central nervous system of a truly global network. The Dutch had successfully linked the silver mines of the Americas, the silk looms of China, and the spice forests of the East Indies into one giant, profit-generating loop. This was the first era of globalism, and it was managed not by kings, but by the balance sheets of the VOC. The strategy was one of ruthless horizontal and vertical integration. In the East Indies, the Dutch didn't just trade, they took control of production. They established a total monopoly on nutmeg, mace, and cloves by forcibly seizing the Banda Islands and eliminating any competition, often with extreme violence. Once they controlled the supply, they could dictate the price in Europe, ensuring a permanent profit margin. But the real genius of the Dutch system was what they called inter-Asian trade. The VOC realized that they didn't need to constantly ship gold and silver from Europe to buy spices. Instead, they could use their fleet to act as a middleman within Asia. They took Japanese silver and copper to China to buy silk. They took Chinese silk to India to buy high-quality cotton textiles. They then took the Indian cotton to the Spice Islands to trade for the nutmeg and pepper that the European market craved. Each leg of this journey generated a profit. The company was essentially printing money by moving goods between Asian ports that had been trading with each other for centuries but lacked the Dutch logistics and capital. This network allowed the VOC to become self-sustaining. By 1650, the VOC was the wealthiest private company in history, employing 30,000 people and maintaining a fleet of 150 merchant ships and 40 warships. This global reach funneled an unimaginable amount of wealth back into the small Dutch Republic. This wealth didn't just sit in chests, it was reinvested into the Amsterdam Stock Exchange, creating a feedback loop of growth. The Dutch were the first to understand that an empire wasn't just about territory, it was about nodes, and flows. They didn't need to conquer entire countries. They only needed to control the ports, the warehouses, and the credit. This lean, corporate model of empire was far more profitable than the land-heavy models of the Spanish or the Mughals. They had turned the entire planet into a series of interconnected profit centers, all reporting back to a single square mile in Amsterdam. This was the pinnacle of the Dutch Golden Age, a moment where a tiny nation of merchants held the keys to the world's wealth. The ultimate test of any superpower is its ability to survive a sustained conflict, and the Dutch Republic was almost constantly at war with the greatest powers of Europe. However, they possessed a secret weapon that was more effective than any cannon: the modern bond market. While the kings of France and Spain relied on massive, arbitrary taxes or seizing the assets of their own subjects to fund their wars, the Dutch Republic pioneered the concept of the public debt. They realized that if a government is seen as a reliable borrower, it can borrow more money at lower rates than any absolute monarch ever could. The Dutch government issued public bonds, known as obligaties, which promised a steady interest payment funded by reliable excise taxes on common goods like beer, salt, and soap. Because the Dutch legal system protected the rights of creditors, even when the creditor was a common citizen and the debtor was the state, the public had immense trust in these bonds. People viewed them as the safest place to put their savings. This trust allowed the Dutch government to borrow money at incredibly low interest rates, often as low as 3% or 4%. In contrast, the King of Spain often had to pay 10% to 15% interest if he could find anyone willing to lend to him at all. Spain defaulted on its debts multiple times during the 17th century, destroying its creditworthiness. This cost of capital advantage gave the Dutch a massive military edge. They could sustain a professional navy and hire mercenary armies for decades because they could simply finance the war. They were the first to treat national defense as a line item on a balance sheet that could be managed through long-term debt. This system created a powerful incentive for the citizenry to support the state. If you owned government bonds, the survival of the republic was directly tied to your personal wealth. This alignment of private profit and national survival was the glue that held the 7 provinces together. By inventing the sovereign bond market, the Dutch proved that a nation's power is not measured by the amount of gold in its treasury, but by the depth and reliability of its credit. They didn't just spend money on wars, they leveraged their reputation to buy victory. This financial innovation eventually allowed them to withstand the combined might of Europe's largest empires, proving once and for all that in the modern world, the banker is the ultimate architect of the battlefield. Success on the scale of the Dutch Golden Age inevitably breeds envy and imitation. Across the North Sea, the English watched with a mixture of awe and fury as Dutch ships dominated the world's ports and Dutch bankers set the world's interest rates. The English realized that they were being outcompeted not just in trade, but in the very systems of commerce. To challenge Dutch hegemony, England began a multi-decade campaign of both military aggression and financial reverse engineering. The conflict began with the Navigation Acts, laws designed to cripple Dutch shipping by requiring that all goods imported into England be carried on English ships. This led to a series of Anglo-Dutch wars, which were essentially the first trade wars in history fought with naval artillery. But the English eventually realized that they could not defeat the Dutch militarily until they defeated them financially. They needed to stop being a kingdom and start being a corporation in the Dutch style. During the late 17th century, the English began a period of intense institutional copying that historians call the Financial Revolution. They looked at every Dutch innovation and sought to replicate it. In 1694, they founded the Bank of England, which was modeled directly on the stability and credit-clearing functions of the Bank of Amsterdam. They revamped their stock market, creating the London Stock Exchange to compete with the Bourse. They even restructured their national debt to mirror the Dutch bond system, ensuring that Parliament, rather than the king, controlled the purse strings to increase creditor trust. The turning point came in 1688 during the Glorious Revolution, when the Dutch Prince William of Orange actually became the King of England. This event effectively merged the financial interests of the two nations. William brought with him a brain trust of Dutch bankers and financial advisors who helped implement Dutch-style credit systems in London. This was the moment the torch began to pass. England had a larger population, more land, and more coal, natural advantages the Dutch could never match. Once England adopted the Dutch financial operating system, they were able to scale it in a way the tiny republic could not. The Dutch had taught their greatest rival exactly how to replace them, proving that in the world of global finance, your most dangerous competitor is the one who studies your ledgers more closely than your battle plans. The year 1672 remains the most traumatic date in the history of the Dutch Republic. It is known as the Rampjaar, or the disaster year. It was the moment the Dutch financial superpower finally met the limits of its power. In a coordinated strike, the Republic was invaded from the south by the massive land armies of the French King Louis XIV and from the sea by the English Navy. Simultaneously, two German bishoprics attacked from the east. The Republic was being squeezed from all sides by the most powerful forces in Europe. The psychological and financial shock was instantaneous. The Amsterdam Stock Exchange, which had seen decades of growth, experienced a total collapse. Panicked investors tried to withdraw their money from the Bank of Amsterdam, and the value of VOC shares plummeted. For the first time, the trust that underpinned the Dutch system was broken. The public looked for someone to blame for the lack of military preparedness, and they turned their fury on the political elite. The most gruesome moment of this crisis occurred in August, when a mob in The Hague lynched the Grand Pensionary Johan de Witt, the brilliant architect of Dutch financial and diplomatic policy, and his brother Cornelis. In an act of primal savagery that stood in stark contrast to the Republic's supposed enlightenment, the mob literally tore the brothers apart and, according to some accounts, ate parts of their bodies. It was a terrifying reminder that even the most sophisticated financial system can be dismantled by the raw, irrational violence of a panicked population. To save the heart of the country, the Dutch were forced to take a desperate measure known as the waterlining. They intentionally breached their own dikes, flooding vast tracts of their own valuable farmland to create a water barrier that the French heavy cavalry could not cross. It worked, but the cost was astronomical. The Golden Age was effectively over. While the Republic survived and would remain a major financial player for another century, it was no longer the undisputed leader. The Rampjaar proved that financial sophistication is a force multiplier, but it is not a replacement for raw geographic and military depth. The Dutch had built a world of paper wealth and global flows, but they were still physically located in a small, vulnerable corner of Europe. The disaster of 1672 showed that the market is only as strong as the walls that protect it. As the waters receded, the Dutch found themselves in a new world where they were no longer the predators, but the prey of larger, more industrial nations that had finally learned how to play the game of money. As the 18th century dawned, the Dutch economy underwent a fundamental transformation that serves as a precursor to the financialization of modern economies. Having lost their absolute dominance in physical shipping and manufacturing to the British and the French, the Dutch did not simply fade away, they pivoted. They shifted from being the world's merchants to being the world's bankers. The massive piles of capital accumulated during the Golden Age were no longer being reinvested into ships and warehouses, but into loans to foreign governments. This period saw the rise of a rentier class, wealthy Dutch families who lived off the interest of their investments rather than the profits of active trade. Amsterdam became the premier international capital market. If the King of France needed to fund a lavish palace, or if the American colonies needed to fund a revolution against England, they went to Amsterdam to find the money. However, this transition made the Dutch economy highly sensitive to external shocks. Their wealth was no longer protected by their own navy, but by the stability of the foreign nations they were lending to. The risks of this new model became apparent during the speculative contagions of the 1720s. While history remembers the English South Sea bubble and the French Mississippi scheme, the Dutch were deeply entangled in both. The Dutch public, desperate for the 1,000% returns promised by these foreign colonial ventures, poured millions of guilders into these bubbles. When the crashes came, they hit Amsterdam with devastating force. Unlike the Tulip Mania, which was largely a localized fever, these crashes were the first examples of global financial contagion. The Dutch discovered that in a globalized financial system, you can be ruined by events happening thousands of miles away. They had invented the tools of modern finance, but they were now being consumed by them. The speculative contagion of the 1720s revealed a structural weakness in the Dutch model. By prioritizing the movement of capital over the production of goods, they had made their entire national survival dependent on the honesty and stability of their neighbors. It was a lesson in the dangers of overleverage and the fragility of a purely financial empire, a lesson that remains strikingly relevant in the era of modern derivatives and global debt markets. The end of Dutch financial hegemony was not a sudden explosion, but a slow, quiet bleed. By the late 1700s, the Amsterdam Stock Exchange was still the most sophisticated in the world, but it was losing its volume to London. The quiet transfer of power was driven by a fundamental change in the scale of the global economy. The Dutch had succeeded because they were the most efficient in a world of limited resources and slow communications. But as the Industrial Revolution began to stir in Britain, the Dutch model of pure finance was no longer enough. Britain had coal, iron, and a massive domestic population, assets the Dutch simply could not match. But more importantly, the British had finally mastered the Dutch financial operating system and scaled it up. They had their own central bank, their own corporate monopolies, and their own liquid bond market. By the time of the Napoleonic Wars at the end of the century, London had effectively replaced Amsterdam as the world's primary financial hub. The final blow came during the Fourth Anglo-Dutch War, 1780 to 1784. The British Navy successfully blockaded the Dutch coast, effectively ending the VOC's ability to function. The once mighty company, the first corporate Leviathan, was found to be riddled with corruption and debt. It was so insolvent that it was nicknamed Vergen onder corruptie, perished under corruption. In 1799, the company was liquidated, its assets seized by the state, and its shares rendered worthless. This transfer of power was solidified when the French under Napoleon invaded the Netherlands, turning it into a vassal state. The Bank of Amsterdam, which had stood as the pillar of global trust for nearly 2 centuries, finally collapsed when it was revealed that it had been making secret, illegal loans to the city government and the VOC. The ledger of Europe was found to be empty. This loss of trust was the final nail in the coffin. The center of gravity had officially shifted to London, where it would remain for the next 100 years until the aftermath of World War I shifted it again, this time to Wall Street. As we look back at the rise and fall of this forgotten superpower, we must recognize that the Dutch did not just leave behind beautiful paintings and quaint canals. They left behind the blueprint for the modern world. Every time you check a stock ticker on your phone, participate in a 401k, or use a credit card, you are operating within a system that was stress-tested in the streets of 17th century Amsterdam. The Dutch invented the grammar of capitalism. They were the first to realize that wealth is not a finite pile of gold, but a dynamic flow of credit and trust. They proved that a small group of people, armed with better data and more efficient financial institutions, could dominate nations 100 times their size. This was the financial revolution, and it was just as important to the development of modern civilization as the scientific revolution or the industrial revolution. It provided the capital necessary to build the modern world, from the railroads of the 19th century to the tech giants of the 21st. However, the Dutch legacy also contains a series of warnings. They showed us the destructive power of the first asset bubbles, the dangers of corporate monopolies that act like states, and the fragility of an economy built purely on debt and speculation. They demonstrated that while finance can create unimaginable wealth, it can also lead to deep social inequality and the eventual stagnation of the nation that becomes too dependent on it. The VOC, the Boers, and the Wisselbank were the great experiments. They were the first to face the agency problem, the first to battle short sellers, and the first to experience market contagion. Their story is the story of our own current financial reality. We are still living in the house the Dutch built. We have simply added more floors and more complex wiring. As we navigate the volatile markets of the 21st century, we are essentially walking the same damp cobblestones that the merchants of Amsterdam walked 400 years ago. Understanding their rise and fall is not just an exercise in history. It is a necessity for anyone who wants to understand how the world actually works. The Dutch Republic may have faded from the front pages of history, but its fingerprints are on every dollar, pound, and euro in circulation. They prove that a nation's true power lies not in its borders, but in its balance sheets. But as the Dutch found out, Even the most perfect financial machine eventually runs out of steam if it loses its connection to the real world of production and innovation. If you found this deep dive into the origins of our financial system insightful, make sure to hit that like button and subscribe to Financial Relic. We explore the hidden economic forces that shaped history and continue to dictate our future. But what happens when the next financial superpower emerges? In our next video, we are going to look at the South Sea Bubble, the moment the British tried to beat the Dutch at their own game and nearly destroyed their entire empire in the process. You won't want to miss it. Until next time, keep following the money.